Hi, my name is Russell Lee and I'm Head of Insurance Solutions here at M&G. In today's webcast, we're going to be looking at consumer debt, which is loans to individuals rather than corporates, and our primary focus will be on residential mortgages. These are attractive asset classes for insurance companies, both from a diversification and a capital efficiency perspective, but understandably investors may have concerns at the present time about the impact of COVID-19 on consumer creditworthiness. Turning then to the first slide, we have an overview of the consumer lending market. Loans, as said earlier, primarily to people rather than to companies, and a large, diverse global market, estimated around 26 trillion euros of balances outstanding on those loans and comprising residential mortgages, auto loans, credit card receivables, etc. Characterized by historically low delinquency and default rates, and also, I guess, since the financial crisis in 2007 and 8, higher origination standards and tighter regulation. So, why are opportunities now arising in this asset class, whereas they haven't in the past? Well, historically, banks have originated these type of exposures and they've kept them to themselves. They may have financed them through the securitization market, but they tend to have held on to the equity or the residual pieces themselves. And they've done that because of the strong historical credit performance on these types of loans. But more recently, bank regulation has been changing and banks are being forced to deleverage their balance sheets, and retail asset classes are some of the things where they have very low risk weightings, but yet with gross average ratios now coming into focus in the banking world. And it's some of these sort of large volume, low margin or low capital type of exposures that are the ones that they need to divest or find other ways to finance. And that creates opportunities for us and for our insurance partners. So why would you want to work with an asset manager? Well, I guess it's getting the diversification, it's getting the origination capabilities that we bring, and the analytical expertise, in particular the track record. This is an established asset class, but yet not many people have invested in it, certainly in the institutional space, and we bring that expertise. There's the attraction as well from a Solvency II perspective of efficient opportunities, and particularly residential mortgages, where the capital requirements are very low under the standard formula and the return on capital is very good indeed. It shows on the left-hand side that over the last 10 plus years since the global financial crisis, then consumers have by and large been deleveraging. So household debt to GDP has been decreasing over that time period in the UK and Europe and the US as well. Now that may well have reversed over the past number of months, but it is a healthier place to start with than corporate balance sheets, which is shown on the right-hand side. So corporates have been increasing their gearing, they have been borrowing cheaply, terming out their debt, and for example, the proportion of BBB corporates in the overall investment grade space has never been higher. So we might therefore say that consumer household leverage has been reducing, whereas corporates, governments and central bank balance sheets has been increasing. So the starting point, we think the basic underlying economics for the consumer lending space is fairly robust. So why should European insurers care about consumer debt? Well, first of all, we have the basic economics. So attractive asset class in terms of the margins, low capital, good historical performance, and the ability to analyze and understand the impact of macro shocks in those portfolios. A lot of analysis can be done at the portfolio level. They really can be stressed hard. And they can be stressed, to be honest, harder than you can stress corporate balance sheets, certainly from an analytical perspective, because it's very hard to disentangle the impact in supply chains and everything that goes into a corporate balance sheet to make up its risk characteristics. And so we think it's helpful diversifier, and for people concerned about downgrades or sectoral deterioration in the corporate space, then we think that these provide an interesting opportunity to diversify away from that. And if you're looking to improve the credit quality of your portfolio, then residential mortgages are probably something you should look at. Return on capital is the other main reason for looking at these assets, and particularly the residential mortgages, which benefit from the counterparty risk module under standard formula. And so that is a low capital and therefore a high return on capital, but also the consumer finance itself, even unsecured consumer debt, which would probably be more in the crossover space. Because it's unrated, then it has modest capital charges under standard formula and attractive return on capital.
The COVID-19 crisis is obviously an unprecedented crisis. Unprecedented because it's the first pandemic we see in the modern era. And it's obviously very different to the 2008 crisis, which was a crisis driven by assets underperformance, leading to a bank getting in trouble and government having to bail out those banks. Whereas the 2020 crisis is a demand shock crisis with people forced to stay at home, unable to work, and in a lot of cases unable to spend either. It's also unprecedented in light of the government measures that have been taken to take out the worst of this crisis. So payment holidays have been introduced for both consumers and businesses, wage support measures to protect employment, as well as, if unemployment cannot be avoided, more generous unemployment benefits. And then government guaranteed loan schemes for SMEs as well. The combination of the first two has actually led to savings rates in the second quarter increasing, ironically, as people were continuing to earn income, not able to spend as much as they were before, and able to postpone payment on the debt that they might have had. So these government measures, with the combined unlimited cheap liquidity provided by central banks and the significant increase in government spending, are designed to ensure that credit keeps flowing to consumers and businesses. So, as much as 2008 was a bailout of the banks, 2020 really feels like it was the bailout of the consumers. And arguably, the consumers are much better in a much better position than corporates entering into the crisis. Slide 8 shows the rates that you can get on mortgages in various European countries. As you can see, they're fairly stable and would look even more stable if you drew this graph as a spread to swaps or equivalent government bonds. The graph at the bottom shows the European rates compared to their equivalent corporate bond yields, and as you can see, mortgage yields are not only more stable, but certainly in the last 7 or 8 years or so, also high yielding.
In this next slide, we wanted to talk you through an example of a real-life whole loan direct mortgage investment, and in particular focus on some of the risk-return characteristics, which are actually very different of that, for example, in investing in a corporate bond or an asset-backed bond. In this transaction, we've teamed up with a best-in-class originator of mortgage loans in Ireland to originate prime, owner-occupied and buy-to-let mortgages at a relatively low LTV. The LTVs that we're originating at in Ireland are roughly 60 to 80%, which is low compared to other European jurisdictions that investors are more familiar with, such as the Netherlands, where mortgage loans are in the region of 95 to 100% LTV. These mortgages are all fully amortizing, and as we said before, in terms of the borrower characteristics, very prime. Towards the middle of the slide here, we've got an example of how the investment performs under different rating agency stresses. Whilst this investment itself is not rated, it is useful to determine and see the returns of this investment under these different stresses. And as we move across to the right, from our base case to the single B, the double B, the triple B, the single A, the double A, and then finally the triple A case, the rating agency stresses are getting harsher and harsher, until finally at that AAA rating stress, we're assuming circa 30% of the pool defaulting. What's very pleasing to see is even in this AAA scenario, the return on this investment is around swaps plus 30 basis points. To give that some relativity, if you imagine a corporate bond in these single A, double A, and AAA stresses, that corporate bond or that asset-backed bond would obviously have defaulted. Finally, just looking very briefly at the chart on the bottom left, this plots, again, risk versus return, with risk being along the x-axis here, cumulative loss and measure of risk, and we've plotted the different returns under each rating agency stress. Moving on to the next slide, we can see that the mortgage opportunity is truly pan-European. Driven by the low LTV of these mortgages, roughly 60 to 80%, and also the very, very wide spreads, the widest in Europe, in fact, Irish mortgages give the highest return on capital under the Solvency II standard formula, sometimes in excess of 100%. Moving on to Dutch mortgages and the Dutch mortgage market. As investors will know, the Dutch mortgage market is driven by long-dated fixed-rate products. The spreads here, roughly at the moment, are swaps plus 150, and the high origination loan-to-values, sometimes 95 to 100%, this drives a lower return on capital, still very good versus other fixed-income products, at around 30%. Looking at France, Italy, Germany, and Belgium, here the rates are somewhat lower, or slightly lower in some instances, but the LTVs are also correspondingly lower, and actually the return on capital available here, in some instances, is actually higher than that in the Netherlands. Finally, at the bottom, we have the UK. And the UK mortgage market at the moment is driven by 2-year and 5-year fixed-rate products and some variable-rate products, but given again the very low LTV under the standard formula, UK mortgages can deliver very high return on capital. In all of these instances, all of the return on capital available pan-European is far in excess of that we would see in, for example, corporate bonds, which is roughly between 8 and 12%, depending obviously on rating and duration.
When we originate or buy pooled loans from originator, we not only look at the loans that we will originate or buy, and not only looking at the snapshot today, but looking at the history month by month of all these loans, but we also draw the origination pool from this originator. So this is millions of data points that we analyze and model and use to determine which are the type of loans that we want from this originator in this asset class in that country, with what parameters and at what yield. So enormous amounts of data that we go through, which requires a lot of analytics behind it. To summarize, unlike the global financial crisis, this crisis cannot be blamed on over-levered consumers or inadequate regulation. In fact, the consumer is entering into this crisis with a much healthier balance sheet than in 2008, much less levered. Unlike corporates who have increased significantly their leverage in the last 12 years or so. The immediate focus of the government have been to dampen the impact of COVID-19 on the economy in general, but consumers in particular, with the furlough schemes, protection of employment, more generous unemployment benefit, payment holidays, all of that has obviously helped tremendously and will have a positive impact on the performance of consumer loans. It is obviously a little bit too early to tell what the impact on the economy in general will be, and therefore on those loans. But certainly, this crisis has all been about bailing out the consumer, as they represent about 65% of the economy, and also because they're going to be the one voting for you in the next election if you are a politician. So for insurers looking for diversification to their core credit portfolio, looking to diversify away from corporates who are going to see a significant amount of downgrades according to the rating agencies, consumer loans offer that diversification, and in light of the regulation, a very attractive return on equity, and so represents a very scalable opportunity, we strongly believe.